Good morning, participants. Welcome to this webinar on the Nifty touching an all-time high and what should be the course of action which we as investors must keep in mind while the Nifty is hitting an all-time high. So this webinar is being hosted by Anand Rathi Wealth Management and co-hosted by 9Cube. So while most of you are familiar with my work and know me, but for those who don't know, I am Rishabh Adukia, a chartered accountant and director at 9Cube. So we at 9Cube basically develop wealth strategies which increase the probability of generating double-digit returns for our clients. And in our experience of managing several HNI clients, we have observed that most of the clients do not have a clear, well-defined objective for the investments they make. And even if they have an objective, it is more biased towards return and not towards risk. So keeping this in mind, a balancing between risk and return, we basically create a well-defined strategy which can be a good trade-off between risk and return. So with these things in mind, maybe we will discuss and in greater detail as to whether market is really overvalued. The falling interest rates for FD, is it really a concern? And if it is a concern, then what should be the corrective course of action for that? Uh, Also, how we can generate double digit returns irrespective of the market condition, be it a bull market, be it a bear market, or a range bound market. So, it is more like if somebody, we are aware of how fuel prices are increasing by the day, and that is happening across India. So, it's not that we have stopped traveling itself in our vehicles. We still continue to travel uh, and use our vehicles in spite of the high fuel prices. Similarly, even if markets are overvalued in your opinion, you still cannot take an opinion to come out of the markets. What one needs to focus on is asset allocation. How well is your money allocated between debt, equity, or other instruments such that you are comfortably geared enough to beat the HNI inflation? Keeping all these things in mind, I would like to hand over to Mr. Ketan, who heads the sales and business development at Anand Rathi, for a very informative presentation on what should be the course of action for investors at the current levels. Over to you, Ketanji.
Okay. Thanks, Rishabh, and very good morning to all of you. Thanks, Rishabh, for setting the context, first of all, and thanks for the introduction. As you rightly said, that people are currently looking at market being overvalued or no. People are also worried about current pandemic situation and stuff like that, whether the market will take some kind of a correction or no. At the same time, if we have alternate assets like debt, instruments, fixed deposits, all that stuff, the rate of interest is going down, and hence the returns from there also is not coping up with what they should get. So what one should do, right? So this is what my presentation will be all about. I'll talk on these three things and how one can create a portfolio in spite of any market situation. As you said, if the market goes up, market comes down, or market remains wherever it is, right? There are only three possible scenarios for a market. How can we build a portfolio which can take care of any of the situations? That is what I'll be talking about. So, friends, I'll be taking next 50 minutes of your time, and I'll take you through the presentation. My request is, if you have any questions in between, please write down in the Q&A section or a chat box. I'll address all your questions at the end of the presentation. Right? Fine. So, let me start. So I think these are the questions which Rishabh you spoke about, right? This is what most of the clients, they told us that they are thinking about, right? So the first question which comes in their mind is that, is equity market overvalued? We are at now 15,860 odd, I think, as of yesterday. So very high. The pandemic is still not over. We're still fighting with the second wave. People are talking about now, already started talking about third wave and stuff like that. So will market take a correction because of this? That's another question. Fixed FD rates are going down, and hence even your mutual fund debt returns also are somewhere between 5.5 or 6% or 6.25 the max, right? So how can I shield my portfolio? How can I shield my investments during this market volatility and falling every rate? That's the questions customers are thinking about or investors are thinking about, right? So let me first address the first question, which is whether equity market is overvalued today, right? And before we look at the equity market, the first important thing what everybody should look at is the current economy, right? Indian economy, and GDP is the best way to discuss that, whether what is the current economy today, right? So if you look at the 4 quarters of last year, which is basically a pandemic year, so if you look at the first quarter on the extreme left, all of us know that India contracted the most. The GDP of India contracted the most in the first quarter, minus 24%, right? And we all know reason for that is because of the pandemic. There was a mobility was down, mobility of goods and people were down by 76%, and hence obviously we contracted the most in the first quarter. But the journey of Indian GDP from first quarter to the fourth quarter is really inspiring. If you can see, minus 24 to the second quarter, it was minus 7. Third quarter, we were the only three countries in the G20 countries, there are only three countries who showed a positive growth of GDP. So India showed 0.4% positive growth in the third quarter, and the fourth quarter, which got over in the month of March, India showed 1.6% positive growth of GDP. So yes, it affected, the pandemic affected our GDP, and though it has affected, obviously, market has still shown the high, top level today, right? So today we are saying that 50,860, in spite of GDP has affected, we are seeing 50,860. So what are the reasons, right? So why equity is overvalued? And if you look at valuation, the common method of looking at the valuation is the P, right? So price earning. So what price I'm paying to get that 1 rupee earning on that share, right? So this is on the left hand side, you can see all the sector-wise P, it's mentioned here. But if you look at the Nifty P, it is trading at 29.1x, right? 29 times is the Nifty P at this point in time, right? So that is why typically when the Nifty is around 20, 21x, people feel that it is reasonably valued, right? But if it is more than that and nearing to 30, people always feel that it is overvalued. But when you look at, and this is the journey of Nifty 50p. So from last year, if you see the quarter ending July 19, October 19, it is from 28, 27, ranging in 20s, 20s to 30 plus, in fact 40 also. And today, in the month of June, we are seeing that Nifty P is 29. So if trailing P Nifty is 29, so is this a correct method to look at the whether Nifty or market is overvalued or no, right? So what is trailing P? The trailing P would mean if you look at the P of Nifty March with the earnings of last year, March 2021, that's a trailing P, which means it is something which has happened, done and dusted, right? So if you look at the something which has happened is 29, that's a trailing P, what we call, right? But that is not the right method. What one should look at is when you look at the market always looks at the future and then it behaves. So the classic example of this is the last year. So if you look at March 20, when the market fell nosedive, right? So market fell by 39% in the month of March. At that point of time, if you look at the earnings of these corporates, it had not hampered. But why market failed? Because market looked at the future, that because of the pandemic, it's a global phenomena, and hence market failed looking at the future. So today, if you're looking at the market is high, obviously market is looking at future, right? So if that is the thing, then what is important to see is not P, but the forward P. What is forward P? Look at the earnings of these corporates for the next 1 year, next 2 years. And if you divide by that to the current market level, you can get the forward P. So trailing P is 29, where we feel that it is high. But let's look at what is the forward P for the Nifty, right? So this is one data, which talks about today. If you look at FY21, the earning per share. How do we find the P is level of a market and divide that by earning per share of this Nifty 50. So earning per share of Nifty 50 was 518 in the March 21, right? So if you divide that to the current market level, you find it is 29. That's a trailing peak, right? But if you look at the future earnings of the future earnings of Nifty 50, that is current year, which started a couple of months back, FY22, March 22, the earning per share of Nifty 50 is 692. That is 34% growth from year on, right? The year after that, the expected earning of these corporates is 797. So which means that if you look at the forward P, so on the bottom column, you can see the 1 year forward P. If you divide to the current level of Nifty 15,800 by 692, you'll see the forward P is 22.9, 23. If you look at 2 year forward P, it is around 19.9, which is less than 20. Right, which means the expected earning of these corporates are 33-34% in the one in coming year growth, the 15% in the next year growth. If you look at that, the forward P is really not very high. So if you look at the long-term average of Nifty 50 for 15 years, 1 year long-term average of 1 year forward P average is 18. And if you're trading at 22 or 19 2 years forward P, it is not very high, right? So I'm sure when you look at this data, it says that Nifty 50 is not at high or valuations are not high. But I'm sure there are two questions which is coming in your mind at this point in time is who's saying that growth will be 33%, 34%, or maybe 15% thereafter, right? So it is not Anand Rathi estimation alone, okay? So there are various research houses in the country. So maybe there are 20, 30 research houses, and they predict what the Nifty level can be or earning per share of Nifty 50 for the next 1 year, 2 years, and so on and so forth, right? So all these companies put together, all these organizations put together, their consensus is that Nifty 50 earning per share will grow by 33-34% in the coming year and 15% in the next year, right? Which means, and Bloomberg publishes this data of which is called Bloomberg Consensus, which is saying that the Nifty 50 earning per share will grow by 33%, 34% in the first year and 15% in next year. So it is not alone one individual or one organization which is saying, it's a Bloomberg consensus, which means the consensus of all these organizations in the country who predicts about the earning per share of these companies, right? Which is what these figures are all about. The second question which might come in your mind is that why this growth will happen, right? So when we're saying 33% will happen or 34% will happen, why it will happen, right? So there are three strong reasons why it will happen, and these are those reasons. So I'm sure all of you must be aware. Way back in September 1919, government changed the corporate tax, and today most of these corporates, larger corporates, are into new tax regime, and all these corporates, they are now paying 10%, almost 10% less tax than what they were paying earlier, right? So that is a huge benefit. I mean, if you save 10% on the taxes, obviously your earnings on 10% is accordingly, right? So that's one basic reason that why earnings per share of these companies are going up is lower tax rate. The second, all of us have experienced that huge cost cutting. Most of the companies are now into new regime of working from home, less cost, infrastructure cost, less electricity cost, less travel cost. The efficiency of people have already. I can give you an example of IT companies, right? So IT companies, what do they typically do? They place their people at let's say their customers' country. Let's say, for example, somebody is working in US, somebody is working in UK. Now all these IT companies have to pay double salary, so they have to pay salary in rupees as well as pay in dollars or pounds as well, wherever the person is working, right? Since last year, everybody has learned to work from home. So people are not going to the country of the client, but they're working from India. And most of the companies are saving huge cost on this double salary. Another example is that HDFC Bank, what they did is last year they announced that whatever their properties are, which is probably branches or ATMs, which are on rent, they're saying that next year or whenever it is renewed, we'll pay you 10% lesser rent. Take it or leave it, right? So imagine the kind of a cost which they'll be saving on such kind of a range and stuff like that. So a lot of companies are saving huge costs since last year. All of us be experiencing that a lot of cost cutting happening with this company. The salaries have come down, the staff have gone down. So all these bigger companies, Nifty 50 companies, their costs have gone down. That's the second big reason why earning per share of these companies will go up. And the third major reason is that the market share. So all these big companies have gained the market share because they are in a better position to work during the pandemic situation and in the current situation and the restricted working environment and stuff like that at the cost of the smaller companies. So SMEs have suffered, right? And all their businesses have gone to the larger companies. So their market share has gone up at the cost of the smaller companies or SMEs and stuff like that. So these are three major reasons why we are expecting that the earning per share of these Nifty 50 companies will go up by 33-34% in this financial year and maybe 15% in next financial year. So now again, I'll take back to the same data. If you look at the earning per share, which is expected, and this is the assumptions of or consensus of all these companies. If you look at now the earning per share of these companies, and then look at the 1 year forward P, the market doesn't look overvalued. So essentially, what we're trying to say is that the current rally which we are seeing is in line with the expected corporate earnings, and this is the main reason for that. So that takes care of the first issue, Rishabh, about whether market is overvalued. We really don't feel that market is overvalued at this point in time. The second important, fear which people have in their mind is about the pandemic, right? So we currently still fighting with the second wave, and people have already started talking about the third wave will come and no and stuff like that, right? So let's look at what are the factors to evaluate the current level of fear. So I'll just take a couple of minutes to explain you this. So these are all on the left hand side. You can see all the components, which is basically vaccination, medication, awareness, right? Strategy to deal with the virus, the implementation of strategy, right? And new strains. And what we have done here is that the point A, which is something what we experienced last year. This is the second column, which is April, May 2020. What was the fear level at that point in time? This is April 2021. Point B, the second wave that we experienced at this point in time. What is the fear level this year, right? On all these parameters. So on a vaccination, I'm sure you knew that last year there was no clarity. So when exactly same time last year, we did not know when we'll get the vaccination and stuff like that. So fear level was very high, 8 to 10 on a scale of 10. On vaccination today, I will not talk about vaccination. Everybody knows about it. Fear level has gone down on this point that only 1 to 2 is the fear level on vaccination part. The medication and awareness also. Last year there was no clarity. The fear level was the moment somebody used to contract with the COVID, people used to get fear, and the fear level was 8 to 10 at this point in time. Right today, we know, or doctors also know at what stage, at what medication should be given, whether it should be delivered a remdesivir injection or the tablets and stuff like that, or home quarantine, or to be hospitalized and stuff like that. So that is, at least tried and trusted method that we know and doctors know about it, right? So fear level on that front is 1 to 2. The awareness, people did not know. In fact, even WHO did not know much about pandemic last time. So awareness was not there. 8 to 10 was the fear level. Today, we all know there's a lot of awareness thanks to social media. The people know many things about this pandemic and how to deal with this pandemic and situation, right? So fear level on this front is 1 to 2. Strategy to deal with the virus. Last year, there was a complete 2 month or 1.5 month complete nationwide, right? So fear level was again 8 to 10 at that point of time on this parameter. This year, we have not lockdown, but a specific partial lockdown that we've seen on state level basis, right? Protocols have been told to people, and people are following all those protocols and stuff like that. So again, fear level is 1 to 2 on this. The couple of points, which is the next 2 points where I feel the fear level is still high, which is implementation of strategy. Last year, completely lockdown followed. This year, it is not followed that strictly. So obviously, at this front, I would say the fear level should be still high as 5 to 6. And the new strains, Delta variant and all that stuff that which is coming every day in the newspaper. Last year, there was nothing of this. We have even heard about it, right? So today, we don't know much about it. So again, on that front, it is 5 to 6. So point which I'm trying to drive here is that there is a difference between the pandemic situation last year and this year, right? And the level of clarity on the factors that we have mentioned today is very high, right? So yes, there is a fear level today also. It is not gone. The pandemic is not gone, but there's a lot of clarity on all those parameters. So let's see how market is behaving in these two situations. So last year, how market behaved on this on pandemic on these parameters at this fear level, and how it is behaving today, right? So on point A, which was March 2020, right? So if you can see, the fear level was 8 to 10, which you've seen in the earlier slides. The Nifty level fell to 7,610. And not only that, but the daily volatility of Nifty was 8 to 10%, right? The daily VIX that we call, it is 8 to 10% at last year, right? Today at point B, Nifty is at 14. This is April data, but today you know it is 1,000 points plus, so it is 15,800 level. The fear level is only 2 to 3, right? Fighting with pandemic, the fear is only 2 to 3 on scale of 10, right? And the VIX has also reduced to 2 to 3%, which means the daily volatility of the market is only 2 to 3% on an average basis. So conclusion is that we're not saying the pandemic is over or the crisis is over, but at point B, at today's level, we feel that the fear level has gone down and market volatility also has gone down, right? So people were expecting that market to correct and fall the way it fell last year. It is not happening. It is not that volatile today, right? So we don't expect a deep correction of 25-30%. What happened last year, 38%, 39%. We don't expect that to happen. Yes, a small correction of 5-10% can happen. And trust me, for 5% correction or 10% correction, you don't need a pandemic, right? It can happen at any point in time. For any other reasons also, in the short-term market, actually, behaves basis the not on the fundamentals but on the sentiments, right? So 5-10% correction can happen at any point in time. And with the economy recovering, I also shared with you the earning per share of the corporates, right? Nifty 50 companies. With economy recovering, the earning per share expected growth, by looking at that, we expect that the market, high chances, high probability market or should deliver better returns to you from current levels, right? So this is the conclusion. If about talking about the market, I think I told you if one should look at the 1 year forward P, 2 year forward P, which is the actual picture depicting that the market is not at high level. We also seen the COVID situation. At this level, we feel that fear level has gone down and the market volatility also has gone down. We don't expect much of a correction here. So last year was unprecedented year. Yeah, it's a year of unknown unknowns, right? And that year has really taught us a lot of lessons, right? And what are the lessons which one should take? Is market volatility a feature? It's not a bug, right? So it doesn't happen that last year it happened. I'll also share data with you for last 31 years how market behaves. So market volatility is a feature. It's not a bug, right? Short-term movement depends upon the sentiments, as I mentioned, liquidity, demand, supply, and stuff like that. And most important, the explanation of post facto, right? So that is how market behaves in the short term. But if you really have a medium to long-term horizon, right, market actually the returns are aligned with the corporate profitability, and which is what we've seen that how we are expecting the corporate profitability to go up in this financial year and the next financial year. So staying invested is more important than the timing the market is what we are trying to essentially tell you, right? But having said that, it is not so easy to stay invested. What has happened last year, we've seen so many people have gone out from the market, right? And what will happen or what typically happens when you go out of the market because of the such a volatility is what I want to share with you now. So this is one interesting data of last 31 years of Nifty. Now, what it shows is that if you look at from point-to-point returns, April 1990, these are the financial year returns from April 1990 to March 2021, the year which got over now, right? So these are yearly returns of Nifty 50. So if you take the average, this is the average of last 31 years. So average of Nifty is 13.8%, which means a decent returns. If you stay on course for this 31 years, probably you would have got returns of 13.8%. But can you see 13.8% returns every year? It doesn't happen that way, right? We just said that market volatility is the feature of the market. So we have seen 44% in the 1 year, then the 244. This is the average, 13.8. The first year 44, then 244, then minus 48, 78, minus 16, 0, and so on and so forth, right? And one more observation here is that can you see at least 3 or 4 bumper years? Now, what I mean by bumper years is those years where the returns were extraordinary returns, right? So, for example, 244% in one financial year, 81% is the next year, then the 74%. Now, all these 3 or 4 bumper years have actually pulled up your average to 13.8%, right? It is not 13% or 14% every year. Because of these 3 bumper years, it has pulled up to 13.8%. Now, tell me, if you have to invest in the market and stay on course for 30, 31 years, how will you know which one will be the bumper year? And that is where people make mistakes and they go out of the market. So this is a classic example. This is the year, last year, returns were 71%. If you look at from April 20 to March 21, that financial year, the Nifty gave returns of 71%. How many people were there in the market in last year? Many people stopped their SIPs. Many people moved out of this asset class and went to debt as an asset class, right? And those are people who were actually deprived of these kind of returns of 71%. So what will happen in the absence of these 3 bumper years? So the next slide, which I'm going to show you, I have now removed the 3 bumper years. The 3 top years I have removed. Now, can you see the average? It has come down to only 5.7%. In other words, if you miss on those 3 years, you are in the market for 30 years, which people feel that one has to be in the market for a longer period of time and stuff like that. So if you are in the market for 30, 31 years, but in the process, if you miss out those 3 or 4 bumper years, the average returns will come down to only 5.7%, right? And look at this in absolute terms. So for example, 10 lakh rupees invested 30 years ago, right? And if you stay on course till 31st of March 2021, right, your 10 lakhs would have become 5 crore 42 lakhs 61,000, right? Huge returns, right? Which is just 13.8% what we've seen, right? But if you miss those 3 years, the top 3 years, 10 lakh would become only 55 lakhs, exactly 10% of what you have seen in 30 years. So, which means that 90% impact is because of those 3 bumper years, because of the 3 best years. This is what has happened. So, this 3 years, if you miss, and this is what I was talking about. Last year, market gave 71%. For some reason, if somebody has missed out on this opportunity, he would have missed out on the 71% returns, right? And likewise, if you miss only 3 years, which were top years, bumper years, your returns will have this kind of a 90% impact has come because of those 3 bumper years. That's the nature of the equity market, and that's how the market is volatile, right? So we have to ensure that still we have to be on course for this 30 years or 20 years or 10 years, whatever can be your journey. It has to be a long-term journey, and you have to stay on course for this entire long. That's how the Nifty or market behaves. But do you have any other alternative for as an asset class? Yes, you have an alternative, which is obviously debt as an asset class, which can probably essentially make investments into fixed deposits or debt mutual funds, bonds, government bonds, and stuff like that. But look at the interest rate from 1998 till today, right? So this is 10-year GSEC, which was 14 at point in time in 1998. Today, we all know that 10-year GSEC has come to 6%. Can you imagine getting returns of 7%, 8% of fixed deposit today from a bank? No bank will offer you, right? No corporate deposits are now 8%, 10%, and stuff like that. So why your FD returns are coming down is basically this reason, that this is why how it has coming down the 10-year G6. And hence, if you go to a fixed asset class as in debt, your returns can come down to 5%, 6%, 5.5%, right? Is it sufficient? Let's see. So what rate your overall wealth should grow? So I'm sure all of you have various products at this point of time. You must have some mutual funds, you must have some fixed deposits, FDs and stuff, corporate FDs, direct stocks, PMS and stuff like that. This is your overall wealth. At what rate it should grow, right? So the basic concept is that your overall wealth, I'm talking about the overall wealth, all your products put together, collectively should grow at least 2 to 3% more than the inflation. I'm sure all of you are aware what inflation is, right? But I would like to highlight one point here, that inflation, which typically what you think, right, which is government is publishing, inflation is 4%, 4.5%, 5%. Is it true for you, right? So this is a data which says that when government calculates inflation, this is how it bifurcates, right? So it says that more than 50% of your income, to be more precise, 53% of your income, which you spend on food and fuel. Now, does it hold true for you and me? The answer is no, right? So this 4.5% and 5% calculation is on basis assumption on the consumption basket of very poor, and that is where this is the calculation. What affects you and me is this. So this is data for last 29 years, and if you can see, gold has gone up by 9.5% CAGR for last 29 years. Education close to 10%. Flight tickets more than 7%. Banquet halls almost 10%. Destination wedding 7%. Real estate 10%. Healthcare almost 20%. Right. So these are all things which you and me spends. You and me consumes those things. Right. So these things are going up at least 10.5%, 11% every year for last 29 long years. Now imagine all your wealth, which is there, and growing at whatever XYZ returns. If it is not growing beyond 10.5%, at least 2% more than this, it will not grow, it will degrow. Which means your wealth have to grow by at least 13, 12%, 13% overall wealth I'm talking about. So FD is not an alternative for sure. Fixed assets can be part of your asset class, but it cannot take you to your target of 12% or 13% for your overall wealth to grow, right? Which means you have to take some kind of exposure to equity market. So how one can create the long-term wealth, right? So we believe that there are basically 3 steps which we have to follow. The first step is set a goal. Where do you stand today? Where is your total wealth? So as of now, it's really it will be interesting for all of you to look at it. What are the products that you're currently having in your portfolio? So you may have, as I said, fixed deposit, direct stocks, PMS, mutual funds, real estate as an investment, gold as an investment, all your asset classes, all your products which you have already invested. Look at where are you. That is point A. decide where you need to go. That is point B, and that difference have to be at least 12.5 to 13%, which I mentioned. And I told you reason also why, right? Because the inflation is 10.5%. So the difference between point A to point B have to be at least 12%, 13%. That's the first step, set a goal of this for an overall way to go, not for a particular product. Typically people make mistake that I will make investments into A product, B product, C product, not for those products I'm talking about. I'm referring to the overall wealth of yours have to grow at 12%, 13%. So take a look at it, your current situation, where are you today? And then plan 12, 13%. If you're already achieving 13% for the overall wealth, I think you're done, you're through, right? But if not, you need to plan, right? So second step is build a plan where you can go achieve these numbers, 12.5, 13% with a high degree of probability. I think this is what something Bishop also spoke initially, that how we manage to create a portfolio which can deliver returns which are looking good for with a high degree of probability. So make a plan how we can reach there with high degree of probability. And third step is that manage risk, right? So when we say that everybody wants to be on a wealth creation journey for long term, right? People say I want to be here for long term, but actually what happens because of the market volatility, there are two type of risk which we come across, right? The first risk is risk of losing capital, like what happened last year, right? So people feel that now I may lose my capital. Let me come out of it, right? So again, you deviate from the long-term journey of wealth creation. So that's the first risk. The second risk is probably you not lose your capital, but the kind of returns that you're expecting from the market, right? Many times it happens that market doesn't perform the way you expect it to perform, right? Market may give returns of only 2%, 3%, 4% per annum. How can you generate returns of 12, 13, 14, which you expect from equity market, right? So that's a second risk, the poor performance, market performance or underperformance of a market nifty, right? So the two risks which you need to manage, right? So these are three steps if you follow, and we help you to get to this your goal. Look at your situation today, where you need to go. We also create a plan for you which can take you there with a high degree of probability, and also manage the risk so that you can stay on the course. If you don't manage those risk of losing capital, you will most often than not you will come out of this wealth creation journey and take some different route and so on and so forth, right? So very important to stay on course. So these are three basic steps. Now let's look at it. How can we create a portfolio which can deliver returns of 12 to 13%? Which means what drives long-term returns, right? So we've seen that FD. Suppose if FD is to give returns of around 12%, 13%, probably I don't need any strategy, right? I can simply invest into a fixed deposit can give you, which can give returns and take you to target, but that doesn't happen. Which means I have to create a strategy. So let's look at what drive long-term returns, basis which I'll create my strategy, right? So this is a very interesting study done by three professors in Chicago University, Mr. Brinson, Singer, and Bauer. Now, what they said, very interesting study. What they said that when you make any investments, like for example, today you decide to buy, let's say, Reliance shares, right? This is one investment that you want to do today. You feel that I'm taking one decision of buying Reliance shares, but actually it is not one decision. There are three sub decisions basis which you have taken one decision of buying Reliance shares. Now, which are those three sub decisions? The first is at bottom you can see asset allocation, which means that the moment you decide to buy Reliance shares, you have decided to get into the share as an or equity asset class. So first decision which you took is that I want to be into equity as an asset class, asset allocation. The second is security selection. You decided to buy Reliance shares. There's so many shares available in the market, right? But you thought of buying Reliance shares, the security selection. And third is market timing. You decided to buy today. You could have waited 1 week or you could have bought 1 week earlier and so on and so forth, right? All these three decisions put together, you took one decision of buying Reliance shares. And look at this study, and they came up with, they said that the maximum impact on the wealth creation journey is because of the 93% impact is because of the deciding what asset allocation I should have. So asset allocation drives your long-term returns. 93% impact is because of that. 5% impact is because of the security selection, and only 2% impact is because of the market timing. And trust me, most of us do exactly reverse. What we try and do is timing the market. Let me wait for, there are various events which comes in the country, and we try and wait for all those events, that let me wait for budget, let me wait for elections and so on and so forth, right? That is not going to make impact on your overall wealth creation. What will make impact is the deciding what is the right asset allocation that you have. This was studied done by three professors in the US. So we said that if this is true, let's look at how asset classes, various asset classes have performed in India for last 31 years. So again, data from April 1990 to March 2021, right? Now it says that if you invest, had you invested 1 crore into all these asset classes, what would have been the value of that 1 crore today, right? Broadly, there are four asset classes: equity, debt, real estate, and gold, right? So if you look at on first, fixed deposit, 1 crore invested in fixed deposit would have become 10 crores, right? 1 crore would have become 10 crores in 31 years. 1 crore invested in gold would have become 15 crores, right? Properties, this is again example taken in Delhi, Bangalore, Mumbai, and the prime locations in these cities would have 19 crores to 24 crores. So 1 crore invested in these cities would have become 19 to 24 crores. That's a range in 31 years, right? Sensex would have gone to 60 crores. So 1 crore in 31 years would have become 60 crores. And now what I'm going to share you is the equity mutual fund performance of 1 crore, right? And again, don't look at the number, the name of the funds. That is not the best performing funds I'm trying to say, but the funds which were available at that point in time. So in fact, some of the funds were launched in 1993, 92, or 95. So what we have done is 1 crore invested in the Sensex and then moved to these funds when they started. In spite of that, look at the result. 1 crore would have become 400 crore to 700 crores, right? Which means the difference is huge. And this is at the CAGR of returns of 21% to 23%, which is much, much higher than the target that we're talking about. Return should be, or overall wealth should grow at around 2.5% or 13%, right? So one clear thing which is coming up from this, that if asset allocation decides or has a maximum impact on the overall wealth creation, equity is the best asset class which is coming up from this, right? So even Sensex stocks has given 14%, mutual funds has given 21, 23%. And one more thing is that mutual fund has consistently delivered returns of 21 to 23% in last so many years, right? Which means if you have to come to the equity in asset class, mutual fund is the best vehicle, is something what which is coming out from this slide, right? So does that mean that we should go and pick up any mutual funds? No, there has to be a process, right? Typically, what people do is that they look at the past performance, just go on Money Control or any site. There's so many sites available, right? Just pick up last top 5 schemes and people. We believe that's not the right method. There has to be, for that matter, there has to be method to this madness. There has to be some process to create your portfolio for mutual funds. There are hundreds of schemes. To be more precise, there are 670 odd open-ended schemes available for your selection. How will you pick up schemes which can deliver returns consistently for you with a high degree of probability? So what we do at Anand Rathi is that we create a portfolio of mutual funds to get to the equities and asset class, right? And when we create a portfolio, this is, I'll just take 3-4 minutes to explain you this process. Those who are interested to understand this process in detail, it's a beautiful process and a very unique process, which I'm sure all of you should understand. So when we have a one-to-one session with those who are interested, we will take you through this entire process in detail. But right now, I'll just quickly explain to you what do we do, right? So here, when we create the portfolio, our first aim is to create an alpha of 2 to 3% over Nifty. That's the objective. So what we're saying that we will not create a portfolio which will give you always 12, 13% returns in long term. No, it will not possible. It's not going to happen, right? But what can be done is that we can create an alpha over Nifty, which means if Nifty goes up by 10%, my portfolio can give you 13%, 14% kind of returns. If Nifty goes up by 5%, this can give you 8% returns, right? So this is the first objective of creating this scientific portfolio of mutual funds, right? So what do we do basically? So there are first, when we, as I said, there are 600 plus schemes available. And if I create, my current portfolio consists 8 mutual fund schemes. So if I create a portfolio for 8 schemes amongst 600 or 700 schemes, right? So more than a selection, the elimination comes in picture first. So there are certain categories which we eliminate, right? Then there are hygiene factors like minimum AUM for a equity AUM for that mutual fund company, the minimum AUM for that particular scheme, the minimum track record, and these are hygiene factors. Once we apply these hygiene factors, we eliminate few schemes. Let's say there are 80 odd schemes left for selection. Once we apply those two filters, criteria for eliminating categories and then eliminating basis the hygiene factors. Then two things what we do is the quantitative process. Now here what we do is there are so many parameters. Let's look at people, as I said, people look at returns, somebody may look at risk, somebody may look at Sharpe ratio, Taylor ratio, various ratios, right? There are 109 statistical parameters basis which you can actually evaluate a mutual fund scheme, right? So which are the best parameters we should pick up, right? So there's again a study which we do a scientific study, and then we come up and we came up with the three parameters, which basically talks about the historical data of these schemes. These three parameters which I mentioned here. So past returns on a rolling basis, the efficiency ratio, down capture ratio. These are all three ratios which are the basically past data. And the fourth one, which is talks about the futuristic behavior of the schemes. What can be the future expected returns of these schemes, target NAV for after 1 year, 3 years. That's the fourth parameter. So basically these four parameters, we apply on those 81 and then we shortlist the schemes. The work doesn't stop there. There's a quality filter. So there's a committee who sit across, and then on those schemes, which is filtered from this process, then they select a particular schemes, 8 schemes, and so on and so forth, right? Then there are two things which is important, which is basically what should be the allocation versus the market cap. So how much should be in large cap, how much should be in mid cap, and how much should be into small cap, and so on and so forth. So there also we apply one theory which is called relative PE valuation model. As I mentioned, I will not explain right now what this theory is all about, but we apply theory basis which we decide what should be allocation into large cap, mid cap, and small cap. But one important thing which I want to mention here is that it is not how much should be to large cap schemes, how much should be to large cap stocks among all those 8 schemes. So, for example, today when I say I have 8 schemes, mutual fund schemes, I know for the fact that I have 178 unique stocks among those 8 schemes. And amongst those 178 stocks, what should be my allocation into large cap and small cap and mid cap and so on and so forth. That is what we come with this relative P evaluation model. And finally, what should be my optimum allocation to each of these schemes? So the moment I have 8 schemes, the moment I have large cap, mid cap allocation, how much of your money, let's say you are investing 100 rupees, how much of that 100 should I invest equal into all 8 schemes? 50% to one scheme and the rest into equal to other schemes. What is the allocation, right? So there is a one interesting theory, which is a Nobel Prize winning theory, Markovitch theory, basis which we decide what should be the optimum allocation should go into each of these schemes. The point which I was trying to tell you in last couple of months or 3 months is that this is the whole process how we go through. As I said, those who want to understand this we can take probably 1 hour to explain you each of these parameters, what are these parameters and how we define these parameters and so on and so forth. What I want you to understand is that there has to be process, there has to be method to this madness, and there are a 52-member team who actually work day in, day out, who not only create the portfolio for mutual fund, which has a higher probability of taking you to a target, but also keep on monitoring. It is not that I keep invest into 8 schemes and then later on I forget, and then later on you do what you want to do in future. No, they keep on monitoring the portfolio. If at all after a year or maybe after 2 years, if we feel that one of the scheme needs to be changed, you know, it is monitored on daily basis, monthly basis. There are something which monitor on the quarterly basis. We also go and meet the fund managers on a quarterly basis and so on and so forth. So they come up and they say, look, now we have to change from A scheme to B scheme because this reason. Ultimately, it will happen with your consent, but this is what we come up with and we tell you. So it is not only creating the portfolio, but also monitoring, which is very, very important for all of us, right? So it is not that though equity is an asset class, can deliver returns. Mutual fund is the best vehicle which can take you to your target, but there has to be a process through which you can get to your right. So, and then finally, when we create the portfolio, so as I mentioned that even after doing all these things, are we saying that my portfolio will give returns of 12-13% at all point in time? The answer is no. Why? My first objective, as I mentioned, is that the objective to give you 2 to 3% alpha over Nifty, which means if Nifty goes up by 3 or 4%, my portfolio also can give you another 3 or 4% addition to that, maybe 70% returns, right? Which is again way below the target of 13% or 12.5%, which we discussed initially, right? So how should we construct the portfolio? So this is how we actually build a portfolio, and these are the various products that we keep in the portfolio, right? So there are only 3 things. What we say is that don't complicate much. Only keep 3 things in your portfolio. Which are those? So on first top row, which you can see here, equity mutual fund. I shared with you how we create a portfolio and stuff like that. But the equity mutual fund, what will you do in your portfolio? It will deliver returns of 15 to 18% for you, right? That is what equity mutual fund is supposed to do. If you look at the risk level, again, it is medium risk level. If you look at it low, medium, or high, equity mutual fund will have a medium risk, right? It has unlimited growth, but and can give returns of around average 15-18%. But for this to happen, market has to go up by 12 to 14%. Then only mutual funds can give you 15 to 18. And we have seen in long term, market has returns of around 13% in 30 long years. But if you look at the probability of that happening in any 3 years, it's only 46%, which means more than 50% time, market has not even given returns of 12%, which means well-managed mutual fund also will not give you returns of 15%, more than 50% time, right? So that's the first product that can have. So what one should do, right? So you have another product in a portfolio, which is again, if you look at the bottom row, which is a debt mutual funds. On the risk parameter, it is very low, extremely stable debt mutual funds. Nothing to do with the equity market, right? It will always give returns of 6 to 7%. Even 7 is now out of question. Maybe 6% returns is what it can give. But it can give you always. So 95, 99% time, it will give returns of 6% to 6.5%, right? So now if you look at the probability, if you have only two things, I've just talked to you about equity mutual funds and debt mutual funds. If you have these two things in a portfolio, look at the portfolio probability, right? So if it is 100% into equity, it will give you returns, what we're expecting, 46% times. If you have, let's say 60% and into equity and 14 to debt, or 70-30, probability can increase to maximum to, maybe 60, 65%, 63%, right? If you have only these two things. So how should I increase my probability, right? So that is where we infuse this one more product in between. So can you see this, the middle row, which is in yellow color? This is called a structured product. That is another asset class which I wanted to introduce you today. And again, if you look at a risk parameter, it is low as maybe debt mutual funds. The standard deviation or risk is as low as debt mutual funds. If you look at the asset class, again, it is moderately stable. What it delivers, now we look at the returns, 12 to 13%, which is very close to your equity mutual funds, right? Equity mutual fund probably can give you 14, 15% kind of returns. This can give you 12, 13%, even 14% returns, right? But for this to happen, Nifty has to go up by only 3%. See difference now. See here, as we said that for equity mutual funds, Nifty have to go up by 12% for you to get returns of 14, 15%. Here, to get returns of 12 to 13%, Nifty has to move up by 3%. And look at the probability. Any 3 years probability, this will 83%, 85% probability, it will give you, or Nifty will go up by 3%, right? So now if you had three things in your portfolio instead of two things, right? If you have an equity mutual fund, if you have a debt mutual funds, and if you have a structured product, right? The probability of you going to your target goes up. Maybe 70, 75% is where your probability where you can go to your target, right? So what essentially we're trying to say is the combination of these three things. You did not have any fourth thing in your portfolio. Just have three things: equity mutual funds, debt mutual funds, and a structured product, right? What it will deliver, I spoke initially that we create a portfolio which can work in any market situation. Let's see how, right? So first is a bull market. So if Nifty does well, Nifty gives returns of 10%, 15% per annum for next 3 years. That is what we call bull market, right? So what will happen? My equity mutual fund will give returns around 15, 18%. My structured product also will give returns of 12, 13%. Debt will give you always 6%. So in a bull market, I'm through, no issues at all. Look at the second situation, range bound market. What I mean by range bound, Nifty give you returns of 3% to 4% per annum. What will happen here? This will give you probably 7-8% returns, equity mutual funds. But this will still give you 12-13% kind of returns. This will still give you 6% returns. Now, if you add these three, at least there are high chances you will get double-digit returns, even in the range bound. Even the market is flattish, right? So you still get returns of 10% plus. Look at the third thing, bear market. Market goes down, right? What will happen? This is at risk for sure. This is exposed to equity market risk, obviously. But this portfolio has a capital protection to a certain extent. This portfolio also is not exposed to the market. And hence, both this portfolio, if you create a portfolio in a particular fashion, in a particular percentage, it has a zero chances, almost zero chances of you losing even your capital when the market is down. So when the market is very still, you can protect your capital. Imagine somebody was not having this kind of a portfolio last year. What would have been the situation? I'm sure most of us have experienced this kind of a situation last year, right? Where the portfolio was exposed to risk, and we've seen the dent in the portfolio by 40, 50%, and many people went away from the market. But if this kind of a combination, if you have any market situation, you will not deviate from the wealth creation journey, which I was talking about initially, right? You have to stay on course, and this portfolio will ensure that you stay on course for a longer period of time, right? So what it does is portfolio, it manages the market volatility, right? It also comes in a plan B for you. So if a plan A essentially is mutual funds, so when the market does well, your plan A mutual funds with a combination of equity and debt can take care of your portfolio and your returns. But if market doesn't do well, your plan B, which is structured product, will come into play, and overall returns will still be at least double digit, and so that you can stay on course for a longer period of time. So this is what essentially we do with this. So I'm sure all of you are aware about what mutual funds is, right? Some point in time you must have invested, but some of you might not know what structured products are. So I'll just take 5 minutes to explain to you what structured products are, right? So your structured products is something like bonds. I'm sure most of you have invested in the bonds, company bonds or government bonds, right? So if you invest in bonds, what you get is a fixed coupon, right? So for example, if you invest into a bond which has a 3 years horizon and it has, let's say, 7% coupon, fixed coupon. So you know for the fact that I'm going to get, after 3 years, I'm going to get my 100 rupees if you invested, I will get 7% per annum after 3 years, right? So this is the fixed coupon. This is how bond behaves, right? Structured products are nothing but bonds, corporate bonds, right? And instead of fixed coupon, it has a conditional coupon. That's the difference. Now, what is conditional coupon? The underline here is Nifty, which means you know what kind of returns you're going to get. Like bonds, you're going to get 12%, 13%, you know in advance, right? But for that to happen, the condition has to be met, the condition of Nifty. So let's say, for example, Nifty goes up by 3% per annum, you will get 13% per annum. Is also told to you in advance, the returns also told to you in advance, right? So these are called conditional coupons. So structured products are nothing but bonds which has a conditional coupon. This is one example which I've mentioned here. So here, can you see the on left hand side Nifty performance, on right hand side the product performance, right? So let's say you invest 100 rupees into a product, which is essentially says that if Nifty goes up by 4%, right? If Nifty goes up by 4% absolute, I'm talking about absolute, not per annum, in next 3 years, for example, this product can give you 100 rupees can become 138 absolute. In other words, returns can be 10% per annum. So Nifty goes up by 4% absolute, product can give you 38% absolute. Or in other words, Nifty goes up by 1.1% per annum for 3 years and 3 months. This product can give you 10% per annum. But one important thing which you have to see here is if Nifty goes up by 30%, this will still give you returns of 10% per annum. That's so there's a cap, right? So your returns will not be maximized if the market goes up. So there's a cap here. Downside, if Nifty goes down by 20%, up to 20%, the capital is protected. So from your level, from 15,000, 16,000 level, if Nifty goes down by 20% in 3 years' time, still your 100 rupees is intact. So that is how this particular structured product works. This is how conditional coupon. So this is the chart which you get in advance. So for example, this product which I was talking about, let's say we're at 15,800 level today, right? Exactly the level which was yesterday. Now what it says, if Nifty goes up by 4% absolute, second column, Nifty goes up by 4% absolute, product, the third column will show you, it will give you 38% absolute. In other words, Nifty goes up, Nifty goes up by 1.2%. That's the IRR for Nifty for next 3 years and 4 months. You will get 10% per annum, right? So what you have to check initially is this is what the 10-year, 1, 2, 3, 0 days, 3 years and 2 months, couple of months, right? What is the standard deviation, which means what is the risk? It is as low as 2.3%, right? What is the target? Nifty target is only 4% absolute. How much you're going to get? 38% absolute. This is what you need to first check. If you think this condition suits you, you can go ahead for this product and it can give you this kind of a returns, right? I spoke about the probability, right? So this product increases. So structured product increases your probability. This is, for example, how it can, how we calculate the probability. So this product, I'm just talking about this product as of now. So I mentioned that if Nifty goes up by 4% absolute in 103298 days, right? This is what the product says. If it goes up by 4%, product will give you 38%, right? So let's see what has happened in the past for the Nifty, right? So this is data from 1st Jan 2001 to April 2021. So what we have done here is that we have taken every, let's say you invest on 1st Jan 2001 and in Nifty and hold on for 1098 days. Then you invest on 2nd Jan 2001 and hold on for 1098 days. Then 3rd Jan 2001 and same number of days. Likewise, you do it for all those entire period that I spoke about, right? So there are around 4,334 total observations of Nifty. We have taken the working day of Nifty. So invest on every working day, any working day, and hold on for 190 days. That's basically a tenure for this product. And then we checked how many times Nifty has gone up by more than 4% absolute, right? So out of 4,334 observations, almost 4,000 times, 3996, Nifty has, but that means 92% time, Nifty has delivered returns of 4% absolute in any of those 3 years and 2 day period, which means the probability of this product giving you 10% per annum or 38% absolute returns is 92%. Look at how many times it has given returns of zero or negative positive returns or zero, right? Which means negative returns never ever Nifty has gone down in this period more than 20% time, 20%, right? Never ever. In fact, during the pandemic also, the day you saw the bottom of Nifty 7,600, whatever that level was, take any from that day to maybe past 3 years or 1098 days, the fall was only 16%. So even that time, last year also Nifty had not fallen more than 16%. So never it has fallen by 20%. So 20% capital protection is sufficient for this product. So this is how this product will work for you. So this is what essentially we're saying, that if you have three things, as I mentioned to you in a portfolio, mutual fund. Why equity mutual fund? Because equity is the best asset class. The mutual fund is the best vehicle to come to the equity that I shared with you. How we create the portfolio. Still, we don't want to depend upon the way we have created the portfolio, because we believe that it will still give you alpha of 3 to 4% over Nifty and not more than that, right? So if and there are chances that Nifty might underperform in future as well. Nifty might go down, Nifty might remain stagnant. What will you do in that situation? And hence we add that one more product in the portfolio, which is a structured product, and that is how structured product works for you, right? So this is how we create a portfolio. What the next step now is, basically what we expect is that complimentary 90-minute session with a partner, Rishabh Badokia. He spoke to you initially, right? So what will happen in this area, that in this meeting, is that will help you to identify your point A, as I mentioned to you earlier. So what we'll do is you can share your complete portfolio detail. In the sense, you need not give us the amount, right? So you need not tell me what amount you have into your stocks, what amount you have into mutual funds, and so on and so forth. Even if you tell us percentage, it's still fine. It will still be able to help you. Where is your point A? So, for example, if you can say I have 100 rupees, my total wealth, out of which 10% into stocks, 5% into mutual funds, 3% to FD, 20% to property, and so on and so forth, right? Even if you tell us that, we'll still help you to identify where you are today, right? The second is that then we analyze your current portfolio. In the sense, there will require the portfolio details. Again, even if you don't mention the amount, it's still fine. But we need to know which stocks, which mutual funds that you hold, right? And then we help you to look at the current state of your portfolio. So, what is the health of your current portfolio? That is the second step. And then we help you to go to the plan B, which is essentially that nothing but difference between plan A and plan B is around 13.5% is what will help you to reach there with a high degree of probability, and with a simple combination of these three products, as I mentioned to you: equity mutual fund, debt mutual fund, and structured products on the overall wealth of yours, right? And why these? Because these are very simple, low-cost products, most tax efficient and liquid vehicles. Which means at any point in time, if you want to withdraw money, you'll be still able to withdraw money, even if you want to stay on course for longer period of time, right? So this is how we'll do, and then simply implement and monitor your portfolio through the mobile app. So we have an app which can be, once you start a relationship with us, you can check and monitor all your portfolio on all the parameters continuously. So these are basically next steps that we expect from you. So those who are interested, we will do this kind of a analysis, right? So the way we conduct our health report, we go and do a health checkup, and then we come up with a report which says that this is the ideal situation for the cholesterol. Yours is so and so level. This is the glucose so and so level, but yours is so and so. Similarly, on all those parameters, we will share with you on a mutual fund portfolio. On asset allocation, I shared with you how and why asset allocation creates maximum impact. So on the asset allocation level, how your portfolio is performing, on portfolio construct, the way we construct the portfolio, I told you, how is your current portfolio working on this parameter, risk adjusted returns. So it is not only returns, but at what risk you're taking getting that returns is also important. Liquidity. So all those parameters will share, and you can see the color coding here. So wherever you see yellow color, which means you are very close to the ideal range. Wherever you see green, you are there, right? And wherever you see red, I think this is the area where you need improvement in your portfolio, and we will suggest you, we will guide you how we can, improve your portfolio on these parameters. Again, ultimately, it is your choice. If you like, you can take the next course of action. Right. So this is how we can get to know your mutual fund portfolio. This is how we also review your direct stocks portfolio. So when you hold direct stocks, we believe that you're the fund manager of your own portfolio, right? So we will also analyze what is your ranking amongst all those fund managers. There are 168 fund managers in the country. What is your ranking among those 168 fund managers? If you are among top 10 also, I think you should not change. What you're doing is right. But if you're not, and most often than not, we've seen that even the equity portfolio which you hold, I'm talking about a portfolio, not a particular stock, that doesn't even deliver returns double digit. So what is the point, right? So you can hand over to somebody who's professional who can manage your portfolio. So this is how we can, analyze your equity stock portfolio. And if you have the lot of insurance policies also, this is how we can analyze your insurance policies as well, right? So there are so many people have taken a lot of insurance policies at some point in time, right? And probably those policies might be good at that time, but then later on, many people realize that these are not good policies, not giving good returns. So better to have a term insurance and then invest into the other investment vehicles, right? So we'll help you about, if you just tell us what are the policies that you may have, whichever company, right? We'll tell you this is what you can get on maturity. This is what if you you'll get if you surrender today, and this is what if you change your policies to another investment vehicle, that can be different. So even for the insurance policies, we can analyze your portfolio. So for mutual funds, direct stocks, insurance, if you have, I'll recommend that you can get this kind of analysis done, and this is complimentary for all those who attended today, right? So you can get this and then have a meeting of 90 minutes with our partner Rishabh Adukia, and then we'll take it forward from there. So that's it from my side. If you have any questions, I'll take it now.
Thank you, Ketanji, for this wonderful session. I would request all the participants to post their questions in the Q&A box so we can, collaborate those questions and consolidate and ask our response to that.
So there are already some questions, Rishabh.
Yeah,
Yes, yes.
there are a few questions in chat box. Better if we can read this.
Yeah, so let me read out, Rishabh. The first
Sure.
question is somebody saying, I joined late. Will I get the PPT? Yes, we'll also share the recording also of this, not only PPT, but this recording also I'll share with you all. What is structured product? I think this question must have come
Yes.
during the
Yes.
course of presentation. I think I've answered these questions, and those who still want to know in detail, definitely we can explain you how structured products are constructed. If somebody wants to understand, you need to have F&O product. No, it's not an F&O product, but basically, yes, it is an option strategy. But how safe this strategy is, that can be explained to you one-to-one, how we construct the portfolio, how it is safe, right? Can be discussed. What are the examples of structured product? I think I've given you one example. If Nifty goes up by 4%, market will give you returns of 38%. That's one of the product which I shared with you. There are various such products, so returns of even 14%. There are 5-year structured products also, right? Typically today, 5-year products are very popular, mainly because 5-year products offer returns of 14%. And 14% for 5 years is extremely good return, which means double your investments in 5 years. At the rate of 14%, you can actually double your investments, right? And we know that after 2 years, 3 years, probably 14% also will be difficult, right? So block your 14% for next 5 years. You can do that as well. So there are various products which can be, discussed with you one-on-one.
There's also a question in the Q&A box that how important is monitoring the investments that we typically do in the form of SIP. So I think it's very, very critical and very, very important for investors to really realize that it's not just about investing and forgetting about it. Gone are the days where people used to invest and say that, okay, I bought XYZ company and just forget about it and let's look at it once we retire. The things and the world, the way it is moving, is becoming very dynamic. So you can't really stick to one company, because the way things are evolving, right from technology companies or even in the auto space, which is traditionally a very old industry. So we are talking of electric vehicles, we are talking of work from home environment, and so on. The way things are progressing, you can't really stick to one particular scheme or one particular industry per se. You definitely need some kind of monitoring and rebalancing on a regular basis.
Yeah. are there any ready-made structured products? Yes, the products are ready-made. So as I mentioned, there are various products. So 3, 4, 5 various options will be available. You can choose any of the structured product which suits you, and you can then invest accordingly.
There's a question on how can we create wealth by investing in equity on a regular basis. So, see, definitely savings is an option which definitely each one of us is doing in some form, be it in bank fixed deposits, be it into mutual funds, be it into some equity investments. So, savings is definitely happening in some form for all the people who are earning. The simple idea which we would want to throw on creating wealth is that investing into equity is more of a necessity, uh, simply because you need to beat inflation, and the impact of that may not be really visible to us today or maybe in the next 3 to 5 years, but once we cross a time horizon of 10 to 15 years, we will really realize the impact of inflation, and that is where the real wealth creation will come into play. So I would say that investing into equity while managing risk is very, very important, and that is the only way in which a real wealth can be created.
Rishabh, I did not see actually your points. Sorry, I did not check
No,
that.
no
You
problem,
couldn't
no
start your
problem.
video. Sorry, extremely sorry.
uh, so we have some more
Then one more.
questions coming in.
Yeah. How important is monitoring? Just in case we don't monitor and keep the SFP, what will be the result? Yeah. So of course, it is very important to monitor your portfolio, the mutual fund portfolio. So when I said there are 52-member team who create the portfolio, but they not only create the portfolio, but they also keep on monitoring day in day out. So somebody is monitoring your portfolio. If at all some changes needs to be done, it will be informed to you. It will be told to you that why these changes are required and so on and so forth. So yes, there are people who are doing it, and you can also check on the mobile app how your portfolio is performing and stuff like that. Is it
So
like
fund of
yeah.
fund. So it's not really a fund of fund. Basically, it's a debenture which is credited to the account, demat account of an investor, with a predefined set of returns which are going to be available depending on the market movement. So, like we ran through an example where somebody can make a 38% or a IRR of around 10% on a very small movement of the market. So it's not a fund of a fund, it's a one time investment which a investor needs to do, and the proceeds will be credited at the time of maturity. uh, so of course the structure products are something which are not, it's not a mutual fund, it's a different product, like we said and emphasize, it's a debenture which gets credited and allotted to a investor, uh, and it can be customized depending on the need of return. So we have structure products right from 10 to 14% returns which can be delivered in the range of 10 to 14%. That is something which we customize based on the need, and for that maybe a one-to-one discussion will be better. How can we manage risk? So we basically have certain options available with us, instruments which are called leaps, leaps, through which we can mitigate the risk, so the capital remains protected at all points of time, Vijayji. And this is something which we have been doing for a number of years, because we do come across a large number of HNIs who do not want to risk their capital while investing into equities because they have burned their hands in the past. So again, that is something which can be done by investing into leaps, which basically help you protect your capital on the downside, even if the market goes to zero. Say Nifty, for example, today is close to 16,000. Even if it goes to zero, you can still protect your capital and it remains intact. So that is how, basically leaps help you to manage risk.
Most important, just to add, Rishabh, most
Sure.
important is that each one of you need to know what is current risk. So typically, what investors feel that my portfolio has a high risk, medium risk, or low risk, but nobody actually quantifies that. Nobody actually number that, and which can be done. So, for example, we can tell you if we construct a portfolio with equity mutual fund, debt mutual fund, and structured product, my portfolio risk which means a standard deviation. That's a tool how you can actually analyze your risk of your portfolio. Is let's say 10.5. But do you know what is the current risk? Has your advisor told you what is the current risk of your overall portfolio? If you do not know, again, that analysis which I spoke about, that will tell you. So we'll tell you that this is overall portfolio, let's say is giving returns of 12%. But what is risk? Just to compare, if you look at our portfolio, which I spoke about 10.5% or 11% kind of a risk, if you have these three things in your portfolio, versus let's say if you have a direct stocks, the risk in your portfolio, if I have to quantify that risk, it will be more than 30%, right? If you have, let's say, PMS in your portfolio, it will range between 25 to 30%. If you have only mutual funds, it may range between 15% to 16%, 17%, right? So every product has attached risk and it can be quantified. So you should know what risk in your portfolio is and then decide whether you're getting returns, which is reasonable returns, fair returns or no. Typically, we look at only returns, but we don't know what risk is assigned attached to that portfolio, which is very important, which I think you should know. And this analysis of portfolio review will help you to do that. How long will you suggest should be long term? Yeah.
See, typically the long term is subjective and it can vary from an investor. However, typically what we suggest is anywhere 3+ years is the minimum period which one must look at while investing into equities. So, traditionally we have done some backtesting for last almost 35-40 years. And the way we try and design the strategy is such a way that there is almost a 85% chance of generating this 13-14% return expectation from the investment. So definitely we are not saying that it's 100% guaranteed return that you will get. But what we are working on is how you can increase the probability of generating this 14%. So the whole designing over 3 years is that there is a 85% chance to generate this 14%. However, the longer you stay, the better. So typically, like in a structured product example that we have just shared, a 5-year period expecting a 14%, you're almost doubling your capital. So it may vary from an investor to investor, but we would suggest that look at least 3+ years as a long-term investment from your perspective.
One thing that what if the company issuing debenture does not honor the contract? Yeah. So yes, the debentures issued in this case is issued by Anand Rathi. So those who are looking at reconstructing their portfolio in this fashion, we share our balance sheet also with them. We explain them how this product will be constructed and why this product in your portfolio. So if you look at our balance sheet compared to other NBFCs, right? Those who raise funds from the market, typically it's for the lending purpose. This is not for the lending purpose. This is essentially debentures for investors, so that their portfolio remains intact and so that they get returns in a longer period of time, and hence the investor stays with us for a longer period of time is what the objective of issuing this product. So entire balance sheet can be discussed and shared with you before you could take the decision. So don't worry on that part.
Absolutely. I think there is enough precaution and enough cushion which is available in the form of assets that are available in a balance sheet of the company issuing debenture, and that can be much discussed in detail on a one-on-one basis depending the need. And there is a question on whether the risk levels are factored in while structuring the structure product. So of course, due care and importance is given while the structuring is done for a structure product. So it's not that the money is collected and the money is being used into some F&O transaction for from the proceeds, and we are trying to speculate and get the returns for you. It's a time-tested strategy for last several years, and it's a one-time deployment of the strategy which happens. So we would also not want to ensure that the returns are lost for client. So that's a level of trust which will get maybe broken. So we do that rigorous back testing, for last several years to ensure that the client returns are reasonably met with a certainty.
And all these transactions which takes place on the exchange and in advance. So for example, if you invest in the product which says that if Nifty goes up by 4%, absolute, you will get returns of 38% absolute. Now this transaction has taken place today. there is no if and but whether I'll get 38 or no, right? If Nifty goes up by 4%, I will get 38%. So that's, and then you have to depend whether exchange will honor or no. That's the question. If somebody has, then obviously there is no answer. But as I mentioned, it happens on the exchange, and hence it is 100% safe, this transaction, from that angle. So it is not depending upon whether so and so person will pay you and something like that. It doesn't happen that way. What is the minimum ticket size for investing in structured products? So structured product has basically primary structured products and secondary structured products. So primary structured products comes up with a combination of a mutual fund. For that, you require a ticket size of minimum 50 lakhs. So structured product will be 25% of that, which is 12.5, and the rest 37.5 will get into a structure, into mutual funds. That combination one can get primary structured product. For secondary structured product, it can come at 10 lakh ticket size as well, right? But secondary structure product depends upon the liquidity. So somebody who has taken the structure product maybe a year back and doesn't want to hold for 3, 4, 5 years, and if it is come for the liquidity, those products are very lucrative in nature as far as returns are concerned, right? As far as the probability is concerned, it is very high probability. So such products, whenever they come for liquidity, we come and offer to the clients, and that can come at 10 lakh rupees minimum ticket size. So then you can probably have a 10 lakhs, 12 lakhs, 15 lakhs into mutual funds and 10 lakhs into structured products. Even that combination is possible. And all these minimum ticket size, which I spoke about, it is not that we require a fresh money from the investor. As I mentioned, you need not invest in this portfolio with a fresh money. You can first look at your current portfolio. You get it reviewed, and then we will recommend that you should do these changes in your portfolio, and that changes can be incorporated in such a way that this portfolio can be created.
So if I take the services from AR, can I invest in direct mutual funds instead of regular mutual funds? So of course, the mutual funds that we invest currently are the regular mutual funds, and the reason simply for that is we are not charging anything additional to a client for the kind of service that we are making available. And it's not just any other platform which is available in the market. So you are getting a lot of additional benefits in the form of the advisory that we do, the regular rebalancing of schemes which is required. So, we were one of the front runners last year before the Franklin saga happened to issue a cautious note to those people who were invested in the credit risk category of schemes almost 15 days before the episode happened, as the things were really visible from the uh, movement of funds happening in the schemes. So the differential cost, I would say, between a direct and regular is getting very minimal, and I'm sure most investors are aware about it. So I'm sure it's like being penny wise and pound foolish. So it's a investor is free to choose from whether to go direct or regular. But I would say that the kind of value addition which we can do to an investor is much more than the savings that he or she may be able to make by himself. And we can also do a review of your existing portfolio, like Ketan emphasized in the slides, which can be an eye opener for most clients as to how your portfolio has performed, what is the risk levels associated with your existing portfolio vis-a-vis what we are taking. So for every 1 unit of risk, what kind of an extra return you could have got from the investment that you make. That is something we try and emphasize, because we are into wealth management and we manage a large part of client savings. So we do take into consideration the risk element before we talk of returns.
The next question is on basically the construct. If we get 38% returns upon Nifty increasing by 4%, looks achievable. Yes. What is the logic on the people who are sitting on the other side of the table? Yeah. So I think, Mr. Mittal, you need to understand the construct of this particular product, right? So it will take maybe 20 odd minutes for us to explain this. So when we actually meet you one-on-one, we can explain you in detail about how this product are constructed. So you'll understand, what is it for the person who's actually on the other side of the table, and how you can get this product. Very simple strategy, nothing complicated in that, but it will take some around 20 or 20 minutes to explain you. So we request you to come on, meet us one-to-one. We can explain this for sure.
I think there is somebody who says that he's interested to connect. He wants somebody to connect from Anand Rathi team so that he's interested to start an account. So we will
So
certainly
what
get
we can
in.
do is, from tomorrow, maybe from Monday onwards, our team will get in touch with you and to fix up the one-to-one meeting. And but what I essentially want to say is that please get your portfolio reviewed. That is most important. As I mentioned, that please understand from us what is your point A. Okay, then we'll discuss along with you what should be your point B, and then the journey. Right. So as we typically say that what is first you should decide as a destination. Let's understand where we today, where we want to go next, and then we'll discuss the journey. Right? Typically, people think of journey first. They think of buying a product, B product, C product, D product, without knowing where they want to really go. Right? So that's very important. Let's first do that exercise with you, and then and during that exercise, if you have any doubts, any questions on the today's presentation, you may ask. If you want to know how do we create a mutual fund portfolio, I explained to you in 3-4 minutes, but probably we can half an hour or 20 minutes to explain you each of those parameters we just spoke about. If you really want to understand that, how we create a portfolio, you can do that as well. If you want to understand the balance sheet, everything can be discussed during that meeting. But first, get your portfolio review. Starting relationship also is very easy. We open the online demat account, and which can be done maybe in 20 minutes time, maximum 20 minutes time online. And next business day, your account will get opened, and then you can either transfer the portfolio or you can transfer the funds online, and the portfolio can be created. It's very simple.
So there is a question on what are the fees for evaluating the portfolio. So we don't charge anything for evaluating the portfolio, existing portfolio of clients. That's absolutely complimentary. It's a very, very detailed review which we do for the existing portfolio. And we will be happy to share our views on your existing portfolio. And there are no, if we invest in the product, what are the fees? So of course, there are no charges for getting into the product. So that's absolutely, so the table will speak for itself in terms of, so that is net of fees, the returns that you will be seeing on the table that you will get. Uh, and of course, for mutual funds,
Question?
there is different charge additionally. So
one question is on what is the minimum amount that one can start with. So you can start with any amount. Did you answer that, or I did not get that?
no, I think that's missed.
Yeah. So you can start with any amount mentioned. So it is not that minimum once amount. Yes, but if you require a combination of a mutual fund and structure product, yes, you require a particular. Let's say you structure product in a secondary will come in probably to 10 lakh rupees, and then mutual fund of 10 lakh rupees, so 20 lakh is what you can start. But to begin with, you can start even only mutual funds. You can start with a couple of lakhs. Also, it's not a problem at all. But as I mentioned, before you could start a relationship, at least first look at your current portfolio, whether it needs some kind of a changes there, because we've seen, as I told you, it's very important for you to know what risk you're attached to your current portfolio. We will share that once you share the portfolio in the next meeting. We will discuss with you in detail about on your portfolio, how it is performing on various parameters, at what risk, and so on and so forth. So if you can move that portfolio, I think that is most ideal thing than just starting a relationship of with 1 lakh, 2 lakh, 3 lakh. You can start any point in time. That's not a problem at all.
Absolutely. See, the emphasis is on that if you're convinced about the whole thought process of we managing funds, the way we manage it, uh, then I'm sure eventually the things will flow. And we would also like to emphasize that given the robust process which goes into constructing a portfolio, and that is how we are able to, manage such a large corpus for our clients. So managing close to 25,000 crores of money for our clients. The simple reason behind that is, we have had a very robust process which goes into creation of this wealth strategy, and we have been doing that for last several years, and it has worked very well for most clients with the repeat money or repeat savings coming in on a regular basis. So it's just about getting a comfort and getting a start, and then things will eventually flow.
Charges you mentioned, right? What are charges for every portfolio? You said that it is
Yeah,
complimentary.
that we've answered that it's
That's
absolutely complimentary. That's answered. So with this, I think most of the questions are
All the
answered,
questions.
uh, and participants are
Fair enough.
free to connect. Of course, we would be more than happy to share, you know, the returns for the clients that we have generated in the last 1 or 2 years, and what kind of. Though I would say that, like I said, minimum is 3 year period which one must look at for any time frame, for that matter, and we can be happy. So probably we are the only wealth management firm across the country which gets the returns audited for our clients. For the returns that we have generated for our clients, it is authenticated by a big four accounting firm to ensure that this is what actually we have delivered, and it is not just numbers that we've made in our sales presentations for you to get convinced about and invest. So of course, that is something which is we take pride in telling. So we would be more than happy to share actual investors'
In
returns.
fact, Rishabh, it is interesting, to actually look at the returns of the last year during the pandemic. For those who invested in only in Plan A and those who invested in Plan A, Plan B, both, uh, what was the difference for them? Because I mentioned that when we create a portfolio with so much of a deep study analysis of all these mutual funds, that doesn't mean that even a situation like pandemic it will give you returns, or a market is flat it will not give you still return, right? What I'm trying to say only is that you have to have a plan B in your portfolio. So it will be interesting to see the overall portfolio of ours with the plan A, plan B put together. That will be a very interesting study for you, Mr. Jain.
Absolutely.
Right? I think, Rishabh, there are no more questions. So
Yeah, I think we've already exceeded
fine.
the time. It's almost 1.5 hours. So I think I thank all the participants for coming in and joining in on a Saturday morning for this session. And we'll be more than happy to get connected for any further questions or doubts that you may have. Uh, Thank you, Ketanji, for taking this session.
Pleasure, pleasure. Thanks, Rishabh. Thanks, everyone. Have a
Thank
great
you.
weekend and stay home, stay safe. Bye bye.